$1 million investment portfolio is not something that requires a high income. It never was. If you earn $60,000 a year, which is close to the U.S. median household income, and you follow a specific, boring, automated sequence of decisions, a seven-figure portfolio is within reach in your working lifetime. Not as a fantasy, as math. In this video, I'm going to show you the exact numbers, what you need to set aside, where it needs to go, in what order, and what happens to it over time. No luck required. No inheritance required. No salary doubling required. The only input this math asks for is consistency. And by the end of this video, you'll know exactly what that consistency looks like in practice, and how to make it automatic so it doesn't depend on your willpower. Before we get to the specific numbers, I need to establish the most important concept in this entire video, because if you don't fully understand it, the rest of the math will feel less urgent than it should. The primary driver of $1 million portfolio on a median salary is not the rate of return. It is not the specific fund you pick. It is not whether you invest $400 a month or $500 a month. It is time. Specifically, how early you start. Here is the most striking version of this I know. Two people, same $60,000 salary, same fund, same 7% average annual return after inflation. Investor A starts at 25 and invests $400 a month until age 65. Total personal contributions, $192,000 over 40 years. Final portfolio value at 65. Approximately $1,050,000. Investor B waits until 35, just 10 years later, and invests the same $400 a month until 65. Total personal contributions, $144,000 over 30 years. Final portfolio value at 65, approximately $486,000. Investor A ends up with roughly twice the portfolio, despite only contributing $48,000 more. The extra $564,000 in Investor A's account didn't come from their paycheck. It came from a decade of compounding that Investor B gave away by waiting. This is the foundational truth of everything that follows. The single most expensive financial decision most people make is waiting to start. Not a bad investment choice. Not a high expense ratio. The delay. And the delay is usually caused by believing the starting amount needs to be bigger than it actually does. Now, before I show you the exact monthly amount that gets you to $1 million, I want to show you a source of investment money that a huge number of Americans are leaving completely uncollected. It's not a trick. It's not a side hustle. It's sitting in your HR benefits portal right now, and most people are either not using it at all or not using all of it. The first step in building $1 million portfolio on a $60,000 salary has nothing to do with how much you personally invest. It's about collecting money someone else is already offering to put in for you. Most employers who offer a 401k include some form of employer match. The typical structure is something like, the employer matches 50% of your contributions up to 6% of your salary, or they match dollar for dollar up to 3% or 4% of your salary. The exact terms vary by employer. On a $60,000 salary, a 3% employer match means your employer contributes up to $1,800 per year to your retirement account, as long as you contribute at least 3% yourself, which is $1,800. You put in $1,800. They put in $1,800. That's a guaranteed 100% return on the matched portion before the market does anything. No investment on earth gives you that. This is why financial advisors consistently say the 401k match is the first dollar that should go toward retirement, always, before any other investment decision. Now, over 40 years, that employer contribution alone, $1,800 per year, growing at the same historical average, adds roughly $380,000 to your final portfolio. That's nearly $380,000 you didn't earn and didn't personally invest. You just had to show up and contribute enough to collect it. Step 1 is simple. Log into your HR benefits portal this week. Find your 401k plan. Check what your employer's match is. Then confirm your contribution is set to at least the threshold that captures the full match. If it isn't, increase it immediately. This single action is the highest return adjustment most employees can make in about 10 minutes. Now I can hear some of you saying, "This sounds great, but I genuinely cannot afford to put $400 a month away on a $60,000 salary." I hear that. And the next section is specifically built for that situation, because the real monthly number that gets you to $1 million is lower than you think, and there's a sequencing trick that makes it feel almost painless. Here is the actual math on a $60,000 salary. After federal taxes, FICA, and a conservative state tax estimate, your take-home is roughly in the range of $46,000 to $50,000 a year. Call it about $4,000 a month after taxes. This will vary by your state and your deductions, so run your own number. To hit $1 million in 35 years, starting at 30, reaching the milestone around 65 at a 7% average annual return after inflation, you need to invest approximately $400 to $420 a month consistently. On a $4,000 monthly take-home, that's roughly 10 to 11% of your after-tax income going toward long-term investment. That number includes your 401k contributions, your employer match, and any additional investment in a Roth IRA. It's not $400 entirely from your own pocket. It's the combined total hitting your investment accounts each month. Now, here is the sequencing trick that makes this feel manageable instead of crushing. You do not start at $400. You start at whatever you can start at, even $50 or $100. And then you apply one rule. Every time your income increases, a raise, a promotion, any income jump, you immediately increase your investment contribution by half of the raise amount before the money ever touches your lifestyle. Your employer gives you a $3,000 annual raise, $1,500. Of that goes immediately to your investment contribution permanently. The other $1,500 improves your life. You never had the $1,500 before, so you don't miss it, but your investment contribution just went up by $125 a month without any reduction in your current quality of life. Do this with every raise for 10 years, starting from even a small base, and you will almost certainly be contributing $400+ a month before you've had to feel it as a sacrifice. Before I show you exactly where this money needs to go, I want to address the thought that just entered a lot of your heads. What about when the market crashes? Because if you're going to stay consistent through 35 years of investing, you need an honest answer to that question, not reassurance. An answer. Where the money goes matters. Not because one fund dramatically outperforms another for most people, but because the account type determines how much of your return you keep after taxes. The order of operations is this. First, contribute to your 401k up to the exact amount that captures your full employer match. This is the non-negotiable first step because of the free money. Second, if you're eligible based on income, max your Roth IRA. For most people earning $60,000, you will be well under the income limit. The Roth IRA lets your money grow completely tax-free. You never pay tax on the gains, not when you withdraw in retirement. That tax-free growth over 35 years is worth a significant amount. Third, if you've maxed the Roth IRA and still have money to invest, go back to the 401k up to the annual limit, or use a regular taxable brokerage account. Inside all of these accounts, for the vast majority of people building wealth on a normal salary, the investment itself should be a low-cost, broad market index fund, something that tracks the S&P 500 or the total U.S. stock market. We covered this in detail in our earlier DCA and index fund videos, so I won't repeat the full case here. Now, crashes. Here is the honest answer. The market will drop. At some point in your 35-year investment window, you will watch your account value fall by 20%, 30%, possibly more. It will feel significant. Every financial news outlet will tell you this is different. This time it's worse. This time the recovery isn't coming. Here is the historical record. Every single market crash since the S&P 500 began has been followed by a full recovery and new all-time highs. The 2008 financial crisis, one of the worst in modern history, saw the S&P 500 fully recover and significantly exceed its pre-crash peak within a few years. The 2020 COVID crash, one of the fastest market drops ever, recovered in approximately 5 months. The investors who got hurt in those crashes are not the ones who stayed invested. They are the ones who panic sold at the bottom, locked in their losses, and missed the recovery. Consistent investors who kept buying during the crash actually bought shares at a discount, which accelerated their long-term returns. Your job during a market crash is to do nothing. Keep the automatic contribution running. Do not look at the balance more than once a month. And if you have any additional cash available, consider investing more during the downturn, because every dollar you invest when prices are low buys more shares than the same dollar invested when prices are high. Everything I've shown you so far assumes you're starting in your mid to late 20s, but I know that's not everyone watching this. If you're 35, 40, even 45 and you're just starting, this next part is specifically for you, because the math is still on your side, just with a different structure. If you're starting at 35, the math changes but the destination doesn't have to. At 35, with 30 years to retirement at 65, hitting $1 million at a 7% average annual return requires approximately $830 a month. That's roughly double what a 25-year-old needs for the same outcome, because you have 10 fewer years of compounding doing the work. Is that harder? Yes. Is it impossible? Not even close. 3 things make the late starter version work. First, catch-up contributions. The IRS specifically allows people aged 50 and over to contribute additional amounts to both 401ks and IRAs beyond the standard limit. These catch-up amounts exist precisely for this situation. Second, income is usually higher at 35 than at 25. The average person's real income tends to rise through their 30s and 40s. The monthly contribution that felt impossible at 25 on a lower salary may be very achievable at 35 on a higher one, especially once the debt and lifestyle-building expenses of early adulthood are behind you. Third, the target itself can be adjusted. The $1 million figure assumes you need your portfolio to cover all your retirement income. But Social Security, which you've likely been paying into for over a decade by 35, will cover a meaningful portion of your retirement income. That reduces the portfolio size you actually need, and a smaller target takes fewer years of contributions to reach. The bottom line for late starters: recalculate your retirement number using the 25x formula we covered in our retirement video. Then subtract your expected Social Security income. The portfolio you actually need to build may be significantly smaller than $1 million, and the monthly contribution required may be more achievable than the headline number suggests. $1 million on a $60,000 salary. The math doesn't require luck. It requires time, a specific sequence of account decisions, and consistency through the inevitable volatility along the way. Employer match first. Roth IRA second. Broad index fund inside both. Raise half rule on every income increase. Automation so it runs without your willpower. And the discipline to stay invested when the news says you shouldn't. That's it. That's the entire system. If this video made the number feel real instead of abstract, subscribe. Every Tuesday I break down one more piece of the actual path to financial independence for people on normal incomes, with the real math behind every claim. Next week, we're covering the debt payoff system that works even when your motivation doesn't, and the specific sequencing that gets you out of consumer debt without wrecking your investing momentum. Drop a comment. How old are you and what's your current monthly investment amount? No judgment, just data. The conversation in the comments on this one is usually the best part. See you next Tuesday.